Stop what you're doing right now. If you think the global monetary system operates the same way it did 5 years ago, if you believe the dollar's dominance is permanent, if you're not paying attention to what central banks are actually doing with their reserves versus what they're saying publicly, I need you to lock in for the next 20 minutes, because what I'm about to show you represents the most significant shift in the global monetary order since the Bretton Woods system collapsed in 1971. And I'm not being dramatic here. We are watching in real time as central banks around the world quietly, methodically, systematically move away from dollar dominance and toward what they're calling a multipolar reserve system, but what is really a return to hard money backed by physical gold. Something fundamental changed in 2022 that accelerated a trend that had been building for over a decade, and most people in the West, most investors, most financial commentators have absolutely no idea what's happening because they're still operating with a mental model from the 1990s when dollar hegemony was unquestioned, and the idea of central banks buying gold at record levels would have seemed absurd. But the data I'm seeing from the World Gold Council, from central bank reserve reporting, from the mechanics of international trade settlement, is making it crystal clear that we're in the middle of a global monetary rebasing. Not a collapse, not a sudden crisis, but a deliberate strategic restructuring of how global trade is settled and how nations store wealth outside the reach of any single country's monetary policy or sanctions regime. The viral narrative on social media that hard money is the only exit ramp for a debt-burdened global economy isn't just retail sentiment anymore, it's what central banks are telling us through their actions. And if you understand what's happening, it changes everything about how you should think about storing wealth. Here's what we're going to cover today, and I need you to stay with me through all of this because the implications are massive. First, I'm going to show you exactly what de-dollarization looks like in practice. Not the theory, not the headlines, but the actual data on central bank gold buying, dollar reserve reduction, alternative payment systems being built, and what this means for the global role of the US dollar. We're going to look at specific numbers, specific central banks, specific actions they're taking right now. Second, I'm going to explain why this is happening now. What changed in 2022 that accelerated a process that was already underway? Why are countries that have relied on the dollar for 70 years suddenly diversifying at record speed? And what do national debt levels, trade wars, and sanctions have to do with it? Third, I'm going to connect this to the hard money narrative and show you why gold specifically, not Bitcoin, not the Yuan, not some new digital currency, but physical gold is emerging as the focal point of this transition. And then I'll give you my framework for what this means for your personal wealth strategy, because this isn't just a geopolitical story. This directly impacts the purchasing power of your savings, the stability of dollar-denominated assets, and where you should be positioning wealth for the next decade. Now, here's why you need to hear all of this. The mainstream financial media in the United States is either ignoring this story or downplaying it as fringe concern. They'll tell you the dollar is still king, that there's no alternative, that the U.S. economy is the largest and most liquid market, so the dollar will remain the reserve currency forever. And there's some truth to that. The dollar isn't going away tomorrow. But what they're missing is the marginal change, the fact that the dollar's share of global reserves has been declining steadily, that the infrastructure for dollar alternatives is being built right now, and that central banks are voting with their wallets by buying gold at a pace we haven't seen in 50 years. This is a slow-motion regime change, and by the time it's obvious to everyone, it will be too late to position for it. But before I show you the current data, you need to understand how we got here, because the de-dollarization story doesn't start in 2022, it starts in 1944 with the creation of the Bretton Woods system and the dollar's rise to reserve currency status. Let me take you back to 1944. World War II is still raging, but the Allies are winning, and they're already planning the post-war economic order. Representatives from 44 countries meet at Bretton Woods, New Hampshire, and they create a new international monetary system. The core of the system is that the US dollar is pegged to gold at $35 per ounce, and every other currency is pegged to the dollar. Countries can hold dollars as reserves and trust that they can convert those dollars to gold if needed. Why did everyone agree to this? Because the United States emerged from World War II as the world's dominant economic and military power, holding the majority of the world's gold reserves, and the dollar was the most stable and trusted currency. For the next 25 years, this system worked. Global trade was conducted in dollars, countries held dollar reserves, and the US effectively exported inflation by printing dollars that other countries had to absorb. But by the late 1960s, cracks were appearing. The US was running persistent trade deficits, fighting expensive wars in Vietnam, and printing more dollars than it had gold to back. Foreign central banks, particularly France under Charles de Gaulle, started demanding gold in exchange for their dollars because they could see the math didn't work. The US didn't have enough gold to redeem all the dollars in circulation. So in August 1971, President Nixon closed the gold window, meaning the US would no longer convert dollars to gold. The Bretton Woods system collapsed, and we entered the era of pure fiat currency, where the dollar was backed by nothing except faith in the US government and economy. But here's the key point. Even without gold backing, the dollar remained the dominant reserve currency. Why? Because oil, the most critical commodity in the global economy, was priced and traded in dollars. The petrodollar system was born. Saudi Arabia and other oil producers agreed to sell oil only for dollars, and in exchange, the US provided military protection. This created permanent demand for dollars globally because any country that wanted to buy oil needed dollars. For the next 50 years, this system entrenched dollar dominance. Global trade contracts were written in dollars. International debt was issued in dollars. Central banks held 60 to 70% of their reserves in dollars, mostly U.S. Treasury bonds. Commodities were priced in dollars. The SWIFT payment system, which facilitates cross-border transactions, was dollar-centric. The U.S. could run massive trade deficits and government deficits because the rest of the world needed to accumulate dollars, essentially lending to the U.S. at low rates. It was an extraordinary privilege, what French officials called an exorbitant privilege, and it allowed the United States to live beyond its means for decades. But that system is starting to crack, and the cracks became a chasm in 2022. What happened in 2022? Russia invaded Ukraine, and the United States and European allies responded with the most severe financial sanctions ever imposed on a major economy. Russian central bank reserves held in dollars and euros, about $300 billion, were frozen. Russia was cut off from the SWIFT payment system. Russian banks couldn't access dollar funding. Essentially, the West weaponized the dollar-based financial system to punish Russia. Now, whether you think that was justified or not given the invasion is a separate moral and political question. But from a purely financial and strategic perspective, what message did that send to every other central bank in the world? It sent the message that holding your reserves in dollars or euros is not safe if you ever come into conflict with the United States or Europe, because those reserves can be frozen or seized. Your wealth is not really yours, it's conditional on maintaining good relations with the West. This was an absolutely critical moment that accelerated trends that were already in motion. China had been reducing dollar dependence for years because of strategic rivalry with the US. Russia had been doing the same after sanctions in 2014. But after 2022, countries that weren't even hostile to the US, countries like Saudi Arabia, UAE, India, Brazil, they all started asking the same question. Do we want 70% of our national wealth stored in an asset that can be frozen if geopolitical winds shift? And the answer increasingly is no. The data is stark. According to the IMF, the dollar's share of global central bank reserves has fallen from over 70% in 2000 to under 60% now. That might not sound like a huge drop, but in the context of a multi-trillion-dollar global reserve system, that's a massive shift. And more importantly, the pace of decline has accelerated since 2022. Now let's talk about what central banks are actually doing, because this is where the story gets really interesting. They're not just reducing dollar reserves, they're buying gold at a pace that is absolutely unprecedented in modern history. In 2022, central banks bought over 1,000 tons of gold. In 2023, they bought over 1,000 tons again. These are the highest levels of central bank gold buying in over 50 years. And it's not just one or two countries, it's a broad-based global trend. China's central bank has been buying gold every single month for over a year. The People's Bank of China officially reports reserves of around 2,000 tons, but many analysts believe they hold significantly more because they've historically underreported. Poland doubled its gold reserves in the last few years. Singapore, India, Turkey, UAE, Czech Republic all have been significant buyers. Even central banks of smaller countries like Uzbekistan and Kazakhstan are accumulating gold. Why gold? Why not diversify into euros or yen or a basket of currencies? Here's the critical insight. Every fiat currency has the same fundamental problem that the dollar has. It can be printed, it can be devalued, and in some cases it can be frozen or seized. The euro is backed by European sovereign debt, which has its own massive problems. The yen is backed by Japanese government debt, which is over 250% of GDP. The yuan is not freely convertible and is controlled by the Chinese government. No other fiat currency offers the combination of liquidity, stability, and independence that central banks need. But gold is different. Gold has no counterparty risk. It's not someone else's liability. A ton of gold is a ton of gold regardless of what any government does. It can't be printed. It can't be frozen by a foreign power. It's been a store of value for thousands of years across every civilization. For a central bank looking to store national wealth outside the dollar system, gold is the obvious choice. And there's another dynamic at play here that most people miss. When you hold your reserves in U.S. Treasuries, you're lending money to the U.S. government, you're financing U.S. deficits, you're essentially funding the very country that might sanction you in the future. From a strategic perspective, that's insane if you're China or Russia or any country that has even potential conflict with the U.S. By moving reserves from treasuries to gold, you're not only protecting yourself from seizure risk, you're also defunding your strategic rival. You're reducing the demand for U.S. debt, which puts upward pressure on U.S. interest rates, which makes it more expensive for the U.S. to service its debt. It's economic warfare without firing a shot. Now let's talk about the infrastructure being built for a post-dollar dominance world, because reserve diversification is only one piece. The other piece is creating alternative payment systems that don't rely on SWIFT or dollar correspondent banking. China has built CIPS, the cross-border interbank payment system, which is basically a Yuan-based alternative to SWIFT. Russia has SPFS, its own payment messaging system. The BRICS countries, Brazil, Russia, India, China, South Africa, and they're expanding to include Saudi Arabia, UAE, Egypt, and others, have been discussing a BRICS currency or a BRICS payment system for trade settlement. Now, I'm skeptical that a BRICS currency actually happens because these countries have very different economic interests and levels of development, but what is happening is bilateral trade settlement in local currencies, bypassing the dollar entirely. China and Russia settle trade in yuan and rubles. China and Brazil have agreements to settle in yuan and reals. India is buying Russian oil in rupees. Saudi Arabia has discussed pricing some oil sales in yuan instead of dollars. These are small percentages of total trade now, but the trajectory is clear. Countries are building the infrastructure to reduce dependence on the dollar for trade settlement. And every time trade is settled in a local currency instead of dollars, that's less demand for dollars, less need to hold dollar reserves, and less dominance for the U.S. in the global system. This is a slow grind. It's not a sudden collapse, but the direction is unmistakable. Now let me connect this to the hard money narrative that's gone viral, particularly in social media and among younger investors and people in the gold and Bitcoin communities. The argument goes something like this. The entire global economy is drowning in debt. The U.S. has $34 trillion in government debt. Europe's major economies have debt to GDP ratios over 100%. Japan is over 250%. China has hidden debt in local governments and state-owned enterprises that could be in the tens of trillions. Total global debt, government plus corporate plus household, is over $300 trillion. There is no way this debt can be paid back in real terms. The only way out is to inflate it away, print money and devalue the currency, so the debt becomes easier to service. But that destroys the purchasing power of everyone holding that currency. So what's the exit ramp? What's the asset you hold that can't be inflated away? The hard money answer is gold and silver, physical precious metals with thousands of years of history as money. The argument is that as governments print and debase fiat currencies, people and institutions will flee to hard assets that can't be printed. This narrative has been around for decades in the gold community, but what's different now is that central banks are validating it through their actions. It's not just retail investors buying gold coins anymore. It's the central banks of major economies buying tons of gold and reducing fiat reserves. That's a massive vote of confidence in the hard money thesis. Now, I want to address the Bitcoin comparison because this always comes up. Why gold and not Bitcoin? Bitcoin advocates argue that Bitcoin is harder money than gold because the supply is absolutely fixed at 21 million coins, whereas gold supply increases slightly each year from mining. Bitcoin is digital, easily transferable across borders, can't be seized if you hold your own keys. These are valid points, and I'm not anti-Bitcoin. But from a central bank perspective, gold has advantages Bitcoin doesn't. Gold has 5,000 years of history as money. Every central bank already holds gold, has vaults for it, has processes for trading it. Gold is not dependent on electricity or internet or any technology infrastructure. In a conflict scenario or infrastructure breakdown, gold still works. Bitcoin is 14 years old, highly volatile, and for a conservative central bank managing a nation's wealth, it's too risky as a primary reserve asset. Maybe that changes in 20 years, but right now, central banks are choosing gold overwhelmingly. Here's what this all means for the structure of the global monetary system going forward. We're not going to wake up one day and the dollar is worthless and everyone's using gold coins for trade. That's not how this works. What's happening is a gradual, multi-decade transition from a unipolar dollar-dominated system to a multipolar system where multiple currencies and gold play a role. The dollar will remain important, especially for U.S. domestic transactions and trade with allied countries, but its share of global trade and reserves will continue to decline. The euro, the yuan, And even currencies like the Indian rupee will take on larger roles in their respective regions. And gold, physical gold held by central banks, will increasingly serve as the neutral reserve asset that no single country controls. This has enormous implications that most people haven't thought through. First, it means that U.S. Treasury bonds, which have been the safest asset in the world for decades, might not be as safe going forward. If central bank demand for Treasuries declines because they're diversifying reserves, who's going to buy all the debt the U.S. government needs to issue? The Fed might have to step in and buy more, which is monetization, which is inflationary. Or yields will have to rise significantly to attract private buyers, which makes the debt service cost explode. Either way, it's a problem for the U.S. fiscal situation. Second, it means the U.S. loses some of its ability to export inflation. In the old system, when the Fed printed money, much of that inflation was absorbed by foreign countries who needed dollars for trade and reserves. In a multipolar system where dollar demand is lower, more of that printed money stays in the U.S. economy, which means higher domestic inflation. The free lunch of printing money and having other countries bear the inflation cost that's going away. Third, it means that protectionist trade wars and fragmentation of global trade become more likely. When everyone was trading in dollars and integrated into the dollar financial system, there was economic interdependence that discouraged conflict. If the US and China are trading in different currencies, using different payment systems, holding reserves in different assets, it's easier to decouple economically. And economic decoupling makes political and military conflict more thinkable. This is a dangerous dynamic that worries me a lot. Fourth, and this is the most important for individual investors, it means that hard assets, real things that have intrinsic value, become more important in a portfolio. When the monetary system was stable and the dollar was unquestioned, you could hold 100% financial assets, stocks, and bonds, and feel secure. But in a multipolar system with multiple fiat currencies all being debased and geopolitical instability rising, you need exposure to hard assets. Gold and silver are the obvious ones. Real estate in stable jurisdictions is another. Productive assets like farmland or equity in real businesses that produce real goods. Anything that has value independent of any single government's monetary policy. Let me walk you through how I'm thinking about this personally, because the theoretical geopolitics is interesting, but what really matters is what you do with your own wealth. I view the next 10 to 20 years as a transition period where the old dollar-centric system slowly gives way to a new multipolar system. During that transition, there will be volatility, there will be currency instability, there will be periodic crises as the system adjusts. The way to navigate that is to be diversified across currencies, across asset classes, and across jurisdictions. I hold some dollar assets because I live in the US and have dollar expenses. I hold some foreign currency exposure through international stocks and bonds. I hold a significant allocation to physical gold and silver, probably 20% of liquid net worth, as a hedge against currency debasement and system instability. I own real estate that produces income. I own businesses that generate cash flow. I'm not concentrated in any single asset or any single currency. The specific action steps depend on where you are financially and what your goals are. If you're young and accumulating wealth, you can take more risk, and your allocation to hard assets might be lower, maybe 10 to 15% in precious metals, with the rest in productive assets like stocks or your own business. If you're closer to retirement and focused on preservation, you might want 25 to 30% in hard assets, with the rest split between stocks, bonds, and cash. If you're very wealthy and concerned about generational wealth preservation across different political and economic regimes, you might want even higher allocations to hard assets and geographic diversification, holding gold in multiple countries, owning property in multiple jurisdictions, having bank accounts and brokerage accounts in different countries. The key principle is that you're building resilience against systemic change. You're not betting on a specific outcome like dollar collapse or gold going to $10,000 per ounce. You're positioning so that across a range of scenarios, from continued dollar dominance to gradual multipolar transition to acute currency crisis, you maintain purchasing power and optionality. That's what wealthy families have done for centuries. And it's what central banks are doing now. They're diversifying. They're holding hard assets. They're reducing concentration risk. If that strategy is good enough for the central banks managing trillions of dollars of national wealth, it's probably good enough for us managing our personal wealth. Now let me address some objections and concerns I know people have. First objection, gold doesn't produce cash flow. Stocks pay dividends, bonds pay interest, real estate generates rent, but gold just sits there. That's true, and that's why I'm not saying go 100% gold. Gold is insurance. It's a store of value. It's what you hold to preserve purchasing power when other assets are failing. You hold productive assets for growth and income, and you hold gold for stability and insurance. It's a balanced approach. Second objection, the dollar has been declared dead many times before, and it's still here. Also true, I'm not predicting the imminent death of the dollar. I'm pointing out a structural decline in dollar dominance that's already underway and will likely continue. The dollar in 2040 will still exist, but it probably won't have the same dominant role it had in 2000. That matters for how you position wealth. Third objection, central banks have been wrong about many things. Why should we trust their gold buying as a signal? Fair point. Central banks are not infallible. But when you see a broad-based, coordinated action across many central banks with different political systems and economic structures, that's a signal worth paying attention to. They may not be right about the timing or the magnitude, but they're telling you something about the direction of travel. And fourth objection, isn't this just fear-mongering to sell gold? I don't sell gold, I'm not a dealer, I don't benefit if you buy. I'm sharing analysis of central bank behavior and structural shifts in the monetary system. Whether you choose to position for that is your decision. Here's what I'm watching going forward to see if this thesis continues to play out or if it reverses. I'm watching central bank gold buying data monthly. If buying stays above 500 tons per year, that's elevated and confirms the trend. If it drops back to the historical norm of 200 to 300 tons, that would suggest the buying spree is over. I'm watching the dollar's share of global reserves. If it continues to decline below 55%, that's significant. If it stabilizes or rebounds, that would suggest dollar dominance is more durable. I'm watching alternative payment systems. How much trade is being settled outside of dollars? Are BRICS countries actually implementing the payment infrastructure they talk about, or is it just talk? And I'm watching geopolitical alignment. Are countries choosing sides between a US-led bloc and a China-Russia-led bloc, or are we seeing more non-aligned countries trying to play both sides? The more fragmentation, the more de-dollarization accelerates. The key insight I want to leave you with is this. The global monetary system is not static. It's not a law of nature that the dollar is the reserve currency. It's a function of economic power, military power, institutional trust, and network effects. Those factors are shifting. The US is still powerful, but relatively less dominant than in 1990. Other powers are rising. Trust has been damaged by sanctions weaponization. Network effects are being circumvented by alternative payment systems, and central banks are voting with their wallets by buying hard assets. This is a slow-motion transition, not a crisis, but it's real, and it has profound implications for how you should think about storing and protecting wealth over the next 10 to 20 years. If you're not positioned for a world where the dollar is less dominant and hard assets are more important, now is the time to think about adjustments. Not panic moves, not going all in on any single bet, but thoughtful diversification that makes you resilient across a range of possible futures. That's what the smart money is doing, that's what central banks are doing, and that's what I'm doing. If you found this valuable, drop a comment below with your thoughts on de-dollarization. Do you think this is a real trend or overblown? Are you adjusting your portfolio to account for this, or are you staying fully in dollar assets? I'm curious where the community stands on this. Subscribe if you haven't, because I track these macro trends and central bank data regularly, and I'll update as things develop. Tomorrow I'm breaking down specifically which central banks are buying the most gold and what their stated reasons are versus what their actions tell us. Stay sharp, think long term, and remember, the goal isn't to predict the future perfectly, it's to be positioned resiliently for the future that's actually unfolding. Talk soon.